A question that keeps coming up, and it's a question that I've had probably 10 times in the last 2 weeks from different clients, which is asking, where do I invest? I'm really interested. I want to buy, I'm interested in buying something, this is my budget, this is what I'm looking to achieve. And I have a whole series of bits of information that they give me. But the general question that I'm getting is, okay, yeah, but where should I invest? Where should I buy property? Where is the location I need to be investing my money? So I thought when speaking to our marketer, Kerry, earlier this week, she said, okay, look, what do you want to do a webinar? And I said, to be honest, the question I'm getting the most of at the minute is where should I be investing right now in property in the UK? So I said, okay, this is essentially what we're going to run the webinar on. So really, really excited to be going through this webinar with you guys. It's a conversation I'm having a lot of, and what the webinar has enabled me to do is basically two things. So for those of you that are reasonably new to our webinars, then you'll sort of understand a little bit how I work. For those of you that have been with us for a while, you'll already understand how all this sort of operates. So my primary focus that I do these webinars for is, one, because it engages new audiences, helps you guys understand what's going on, gives you really useful market information on where you should be sort of spending your time, your energy, and enables you to get a whole bunch of information, essentially free coaching, free mentoring very quickly. For those of you that don't know me, I've done property mentoring and coaching for give or take about 8 years now. Been full-time property for about 12 years, 11 years. I've literally trained tens of thousands of people from the front of the stage. I've been presenting for 6, 7, 8 years. So, that's kind of my shtick. That's what I do. And I've been helping people build their portfolios for many, many years. And one of my favorite things to do when running a webinar or running a video or some sort of recording is do information that is valuable, not just because it's valuable for you to be checking out now, but it's valuable to engage when I speak to a new client and someone says, okay, hey, Rich, I'm interested in buying some property, I'm interested in this, I'm interested in that. And they want to get some background information in terms of, where they might be able to invest or whatever else. Rather than me sitting there and having to repeat myself over and over and over again on all the conversations, I'll typically just say, hey, look, here's a link to a really cool webinar that we've just run. Go check this out. This will really help you out, and it'll give you all the information. And rather than me spending an hour on the phone with you going through all the information we're just going to go through on this webinar, it makes it much easier for you to then just watch the webinar in your own time. You can skip around, you can pause, whatever else. And it means that the time that we actually spend together is much more concise and much more efficient and effective on delivering and getting you where you want to get to and getting the outcome you really want to get to. So really, really interesting. So I hope you guys enjoy the session. I'm genuinely excited about this. I love to talk about where we invest, where our clients investing, where you're going to get good returns in today's market to enable you to be able to make more money. And if you like to make more money, if you like to create more financial security, create more freedom through that money, and create a better life, not just for you, but for your future generations, then you're 100% in the right place. This is quite literally what I've been doing for best part of a decade now. So hope you guys enjoy. So this webinar is basically on where you should be investing in 2023, and basically what I believe is the UK property hotspot and what I believe the market is going to be doing coming up. Now, for those of you that catch a lot of our webinars, you'll notice that some of this stuff we repeat because it crosses over between the different webinars. But for those of you that haven't watched a lot of our other webinars, hopefully this is really valuable and you take a lot of value, including those that have watched it before. But those that haven't watched it, you won't have caught any of the previous crossover as well. Okay, clicker is not working today. Okay, so looks like I'm doing this manually. Okay, so obviously in the UK, as you guys know, we operate, we're a very small country, well, very small cluster of countries, England, Ireland, Scotland, Wales. So we're a small group of countries, but we do make up a very good populace, and we actually have a surprisingly varied sort of investment sphere across the entire sort of continent, or country really, of Great Britain. So you'll have different areas where you'll have different strategies, you'll have different price points, you'll have different timings, you'll have different points in the cycle. So there's a whole bunch of things that you need to be considering when you're looking at where you should be investing, and what's the most effective place, where you're going to get the best bang for your buck, where you're going to get the best returns, the best capital appreciation, and so on and so forth. So there's a whole heap of information that you need to be able to understand. Now, rather than you going through all the exercise of researching, spending hours, sort of looking at the data and the stats, and we've done a lot of that. If you look at some of our very early webinars, you'll see some of the data we've accumulated over the last 20 years. I'm going to take the next half hour or so, and I'm just going to walk you through all of the different things you should be aware of within the different regions, whether it be around the different price points, whether it be around the different growth structures, the different points of the cycle, the different strategies that work, whatever that information is. I'm going to spend the next half an hour going through that. So if we start with the epicenter, technically, of the UK, what people would call the epicenter, which is London. And for those of you in Scotland, Ireland, Wales, I'm really sorry, I don't mean that in a bad way, but what I mean is London is the financial hub of the world. So I think it's fair to say it's pretty central in terms of how it operates. And if we start there, and what we'll do is we'll start to work our way out from that point. And you will be able to include parts of Scotland and Wales within this. Ireland, we don't actually do much in Ireland because it's a bit of a quirky investment market. But if you are in Ireland and you want to invest in the rest of the UK, do reach out. We're more than happy to be able to assist. It's part of what we do. So really good conversation. So if you start with London, so London is a very high value area. So the property prices tend to be extremely expensive. And this is central London, including Greater London, all the way out to, say, the M25, give or take. So these sort of areas tend to be very expensive. And by being very expensive, they tend to have a stronger growth pattern. By that, I mean, is typically it'll grow at a very good percentage year on year. Whenever London crashes, as a general rule of thumb, not always, but as a general rule of thumb, it doesn't crash like many other markets where it really goes down. It tends to just level out for a period of time because it's a little bit more of a buoyant marketplace. And the sheer number of people within London in comparison to outside of London as a general mean that market is less likely to bottom out, much more likely to just maintain some semblance of buoyancy. And that's buoyancy due primarily to supply and demand. Very simply. So there's a finite supply, there's a lot of demand for those properties, and there's a ton of international money here. So you've got, as an example, I think it's 70 or 80% of central London is owned by international money. So just to give you a bit of a flavor as to your primary sort of competition within these sort of regions is you're going to have a lot of international money pumping in there, as well as UK money, as well as people living and residing within those areas. So something to consider. It's what creates the buoyancy, and it's also what creates the growth in those areas. But what it also does, so that's your positive, so you create your growth. What it also does is it creates some negatives. Okay, so those negatives are typically very high priced, and therefore, as soon as you have interest rates of over 4%, these areas you can't get the same kind of leverage, can't get the same kind of percentage lending. So a normal mortgage for a buy-to-let, you can lend 75% from the bank, and you only put in 25%. Once you get into London, in most of these areas, it becomes much more complex, because especially with interest rates now at around 5%, you're really struggling to be able to leverage up near that. And in reality, in London, you're leveraging around 50 to 60%. So the amount of money you have to pump in as a percentage is significantly higher. So that's the first thing, is your weakness is that you're pumping in a lot more money as a percentage of the value of the property. The other thing is, because of the value of the properties being so much higher, you're pumping in so much more money anyway, even if you're only getting 75% lending and only putting in 25%. 25% of £1 million house is significantly more than 25% of a 70 grand house. Obviously, simple math. So that's the other really big downfall. And the final one is your yield. So the amount of money you're making as a rental income from these properties is abysmal, legitimately abysmal within the London region. So you have to be much more adventurous in terms of what you're doing, much more adventurous in terms of, you're either doing service accommodation, or you're doing HMOs, or you're getting a renter in who's going to guarantee rent at a good market value. So you're having to do something that's a little bit more adventurous just to be able to make enough money to cover your mortgage and give you a little bit of an income. So it becomes a much more complex environment, and the effects that you feel from a 0.5% change in the base rate, or the 0.5% change in the interest rate, is huge in comparison to like an 80 grand house. It is massive. So an 80 grand house, you have your 1% increase or 0.5%, you're going up like £30 a month or whatever it is. You do that in London, you've got your £1 million house, you go up by 1%, all of a sudden you've gone up by 10 grand a year. It's another grand a month. And you're going, geez, like that's, there goes any sort of money that you had coming in. So it's the difference is massive. And considering the yields are so much lower in London, it makes it a much more complex market. Now, one of the other benefits, though, one of the other strengths is, because the values of the properties are so high, it enables you to what we call create value. So when it comes to properties, there's kind of, hey, Dean, if you've got any questions, do feel free to drop it straight in the chat, man. Thank you very much. questions in Q&A or chat, obviously, anywhere throughout while we're presenting, guys. Please feel free. I've got no qualms answering questions on the fly. I mean, this is what I do. So feel free to drop anything in the chat or in the Q&A, and I will happily jump on that as the questions come in. So essentially with the property, there's a couple of things that you can do. So you can just buy a good property in a good condition, just rent it out. Okay, it's nice and easy. You can add value by refurbishing and tidying up the place and bringing it back up to its average market value. Or you could do something called creating value. So creating value is you'll have an average market value for a property. So let's say it's worth 250,000 because that's what all the houses sell for in that region within that price line, similar houses. Now, what you can do is you can create value by doing things like loft conversions, extensions, basement conversions, making it much more luxurious so you can fetch a higher price. So you get a lot more flex in terms of how you can create value, splitting into apartments, splitting the titles. So you've got a lot more flexibility on some of the stuff that you can do to be able to create value. Now, the reason I say that is because if you do, say, a 3x3 extension, so a 3 meter by 3 meter extension on the back of a house, it's not a massive extension. You've got a two up, two down, little terraced house. In certain parts of London, they might be worth 300,000 as an example. You do this 3x3 extension, all of a sudden you've added 30,000 to the value of that property or whatever the figure is. And it's just ballparking here. But if you do that up north, that extension will typically cost you about 10 grand to 12 grand to get it done. And you're not going to be adding 10 to 12 grand onto the value of the property. So you can't justify having done that work. Whereas in the south, so in and around the London areas, and the very high value areas, and this includes certain city areas like, parts of Manchester, parts of Leeds, parts of, Bristol or Birmingham, or, areas where your average property price is like 400,000. So your higher value areas, but, focus primarily on London, you can create value in those properties, loft conversions, those sort of bits and pieces. But your general houses outside of those areas, you're not going to be able to do the same. So there's some swings and roundabouts within the London area. Now, the problem you're going to face is every man and his dog is trying to do this. They're trying to add and create value to these properties within the London area. And you've got international investors, UK investors. So your competition is rife. So to be able to find property that is fairly priced, you can buy at a fair price and be able to get something that you can do some work on to be able to create the value is actually a surprisingly tough task. Now, we do get them from time to time, but honestly, if that is your primary focus, you would legitimately make a lot more money if you were to invest further afield. But you just have to get out your comfort zone to do that and maybe build a further team or, do a little bit more traveling or whatever it is that you feel you need to do to make that happen. Okay, so that's the first piece, which is sort of London. Now, if you move out of London, you move more into what we call the commuter belt region. So this is, so if you're west, you're talking maybe out Reading Way, north, maybe St Albans, Hemel Hempstead, Hertfordshire sort of way. East, you're into sort of West Kent and Central Kent, maybe, well, not quite Central Kent, but primarily West Kent, so Medway towns, Seven Oakses and Tunbridges and all those areas. Further south, parts of Sussex, Guildford, all these sort of regions. So maybe within 15, 20 miles of the M25, basically going all the way around. So these are your general commuter belt areas. Those areas at the minute, you can kind of benefit depending on where you're buying from the same creation of value, but you have much of the same problems. So fortunately, you can pick these properties up at a lower price. So instead of you spending, particularly, you go to parts of Medway towns or there's certain parts of Hertfordshire, I suppose, not really that many. And again, certain parts of Sussex, but I suppose not that many. But there's going to be regions where you can pick up, those houses for like 250, 300,000 instead of spending, 500,000, $750,000 in London. So you have the ability to do a little bit of value add work. Okay. A little bit of value add work. But again, because the values are so high, you're going to be facing exactly the same challenges as what you do in London, just on a lesser sort of level. So your yields aren't going to be amazing. You'll only be getting like 6% yield or 5% yield, whereas in London, you're like 3-4%. Okay, so you'll make a little bit more income, which means you have a little bit more flex in terms of where you're going, and it becomes a little bit more of a middle area investment, which is why you've got a lot of investors that are invested into Kent or, up into the Essex regions or, in Hertfordshire or whatever. is because they have a little bit more flex. So London gets overpriced, gets too expensive, or the rates go up, can't invest there anymore, let's go out one location. Now, for me, these are people that I would say are basically following the down wave. So as the wave's going down, everyone's jumping on the down wave, and they're just about to lose out because they're always just treading water just ahead of how much you can work and just ahead of making enough profit. Okay, which for me is never a great place to be. So if you, and I'll talk a little bit about cycles in a minute, and I appreciate I'll talk really fast. If there's anything you want me to slow down on or go over again, drop it in the chat. I will happily jump back on that. So please feel free to do that. More than happy to do that. So if you figure a wave typically operates in the ocean, so you have a wave that then follows through, and in the wave you've got the top and you've got the bottom. Now, what I tend to see is you've got a lot of people here that are trying to ride at the peak of the wave, but sort of kind of behind the peak of the wave, and they're kind of always on the downslope, and they're always trying to play catch up. So people that have invested within certain regions, so they stop investing in London because it just becomes a little bit too unaffordable, or the rates have gone up too much, then they just invest just outside. But again, they're investing beyond the crest of the wave. They're further back than the crest of the wave. So they're constantly playing catch up. They're constantly what we call late stage investors, right? So they are behind the curve. Okay, now if you're investing in these areas while London was like going up and its values were starting to really boom and everything was starting to skyrocket and rates were low, then you were essentially investing maybe a little bit too early. So it's when London started to get too unaffordable that you should have been investing in those areas, as opposed to when London is too unaffordable, because you're too late to the game. And I'll explain that again a little bit more in depth as we go into the cycles. Then you move out of your commuter belt areas and you move into sort of just your more, I want to say rural, but it's not really the right term. So you've got your Midlands, you've got some of the West Country, you've got central Kent, all the way out sort of Norfolk, sort of East Essex. So you've got a much wider band where you've got the commuter belt on the inside, and just think sort of 40, 50 miles outside of that, all of those sort of regions. These areas were, this is where you'll have things like Birmingham, Nottingham, maybe into Leicester, Coventry, Sheffield. Oh, sorry, not Sheffield. Sheffield's too far. Coventry, Stoke-on-Trent, and essentially you have a different band of properties. Now, these areas are areas that 5, 6, 7 years ago were unbelievably good to be investing in, and like 9, 10 years ago were beyond measure as to how great they were. Because you could buy properties for really cheap, they had reasonable yields, the market was going up, and essentially you were in a range where you had a lot of people who wanted to move towards the commuter belt to do more London work, but they weren't quite in that position. They didn't really want to do that, but they were living close enough that you had the benefits of the good capital appreciation, you had the benefits of the good growth, benefits of really good rentals, and benefits of okay yields, but really, really, really good demand. Okay, so in terms of regions, that's your sort of next phase. Now, when you go a little bit further out than that, then you're going into sort of Wales, the depths of Wales, the proper West Country, East Kent, all the way into the East Midlands, up into the south of the north. So so you've got your Leicesters, all the way up to maybe Manchester. You've got your Sheffields, Leeds, all these sort of regions. So these regions outside of the cities, if you focus on the cities, similar to what you do with London, just at a delayed effect. Outside of these regions, you have the benefits of being able to buy lower value properties, which is great. So you can buy stuff that will have reasonable yields, so you can make a good rental income, terrific demand, reasonable capital appreciation. So they are areas that will grow in value quite nicely, because they are as far south as they are. And I appreciate you're in the south and the north, but you'll have reasonable capital appreciation, terrific demand for rentals. I mean, you'll have terrific demand for rentals across the whole country. So that's one that will continue to come up. It was a slightly more mature market, a little bit more aggressive and ahead of the curve. Now, we actually started our investment journey. I started, like I say, it was like 11, 12 years ago, or 10 years ago, whatever it was quite some time ago. I think I started it's 10 years ago, 2012. By 2014, I was investing in Nottingham, Derby sort of areas. Those are sort of my regions to be investing in. And these are sort of a little bit earlier in terms of the trends, a little bit further south. And these areas were getting a little bit too hot. It was becoming, when you're doing what's the term, best and final offers. So you're in there, you're trying to view a house, and all of a sudden there's another 4 other people, and the agent's going, oh yeah, it's best and final offers on this, or you're trying to negotiate, oh no, it's best and finals. So what this means is that market's become too aggressive, it's become too hot. Okay, so you're getting a lot of this, which basically means you're competing against too many people. And once you start competing against too many people, whatever's on the market, there's no point investing in. If it's off the market, sure. I mean, if you can get good stuff off the market, it is what it is. We've got good stuff in Nottingham at the minute off the market, discounted, all that stuff as well. But once you start to get to that position, best and final offers, or stuff that is in need of a good refurbishment, but they're selling it at market value and stuff like that, you know that market's too hot. Now, ironically, that's where the market was when I started investing in Nottingham like 8 years ago, okay, in 2014. So the market was pretty dead. So what I actually did is I then took a scattershot approach and just took a look at a whole bunch of areas in the UK and essentially looked at ways in which we could find the best properties in the market. The way in which we did that is we looked at what we believe the properties are worth and what they're on the market for. And if they're on the market for, properties in need of refurbishment, and if they're on the market for less than, on average, less than what the asking price, what the end value was, we know that those marketplaces were probably reasonable areas to be looking in, or stuff that was in good condition was listed around the actual value of the property. Once it starts getting listed above, the market's too aggressive, or if it's listed below, the market's depressed. Okay, so it's a really, really good indicator. The other really good indicator is the speed of sale. When stuff gets listed on the market and when it gets sold, as your average, that will then tell you how much the market is moving up or is moving down. So if it's depressed, or if it's booming, or if it's just level and operating as standard. So we did a whole scattershot approach, and we found the best market for us to be working at the time was Warrington, which is west of Manchester and east of Liverpool. And Warrington, smack bang in the middle, is fantastic. We bought an awful lot of properties there in a very, very short space of time. And like I say, the benefits to these areas were you were still getting strong capital growth, but you were able to get really good opportunities with a decent yield. You're able to get good discounts, able to get good growth. Unfortunately, you weren't able to do creation of value. You can add value, you refurbish stuff, but creating value was very difficult. Unless you ran your own build team, you could do stuff at a low price, and you're essentially creating value by not taking a salary for that work. So there was the other sort of side of that, where you're essentially creating that value by trading time for money, which is essentially no different to a job. But a lot of people did that very, very effectively. I've got some people that I know, some friends, some not so much, that did extremely well in that period, exactly the same period of investing as we were in there. And they were doing creation of value, but they were running build teams and stuff. But if you didn't have your own build teams and development teams, and you just operated with a team that you would pay as standard, you primarily focused on adding value through refurbishing, bringing back up to standard, getting to a good finish, so on and so forth, as your value add. Or you could do things like planning gains, etc., which gets into the more complex fields. So this is the south of the north. Now, if you go a little bit further north, okay, and you move out of the south of the north, or you move further out from London, so you're essentially out, technically past Wales, so Wales is gone. You essentially the only place left on the map for you to go is like as far west as you possibly can, so Devon and stuff. And I don't really spend much time doing any work there because typical demand stuff. But if you go right up north, so you're talking the Newcastles, Middlesbroughs, Durhams, Darlingtons, Lancashires, Carlisle, so Barrow-in-Furness, all these sort of areas. So you're talking right on the band before you hit Scotland. These sort of locations. So you've got your strengths and weaknesses, your contras are. You can buy extremely well-priced stock. So basically you can buy houses for 60, 70, 80, even as low as 40, 50 if you want, but make sure of mortgageability, because you can't mortgage anything where you've got a loan that's too small. So, you can buy some really good stock. So, anything over 50,000 is kind of mortgageable, but you really want over 60. But you can find that really good stuff there that rents out for a really high amount, which basically means you make significantly more bang for your buck, significantly more money. Okay, which is a brilliant, brilliant value add to be considering. The challenge is your growth rate is only going to be around 4 to 5% a year, maybe 5 to 6. Whereas in London, you're going to be 5 to 6, maybe even 6 to 7, in certain regions a little bit higher. So although it's not a massive difference as a percentage, but there is a difference for sure. So you won't get the same sort of growth rates. Tenant finding and stuff is absolutely fine. There's an abundance of people looking for homes. 69 million people in this country, 30 million homes. I mean, you can do the math. There's plenty of people to go around to fill the property. So we don't tend to have any issues with that. You don't tend to get the same growth, but you get unbelievably good yields and unbelievably good returns. You make significantly more money. Right now, you can buy stock for a really fair price, which means you can buy stuff that is discounted enough to be able to justify adding value and doing things like buying, refurbishing, and then refinancing, pulling some of your equity out, and then going again and recycling some of that money into another deal. So you've got some really, really good opportunities. Again, you can do it through value add as opposed to value creation. 70 grand house, you do a 3-bed extension, a 3x3 extension. It's still going to cost you 10, 12 grand, but you're not going to create 10, 12 grand of value, maybe 3 or 4. So it doesn't justify the means, although it'll increase your rent and your cash flow, but it'll take you a very long time to recoup that money. So it often doesn't make sense to do it in those areas. So you've got a bit of a mixed bag, a bit of a scatter in terms of different strengths, different weaknesses. And I kind of wanted to go through that so you guys can understand and get a very fair estimate of what areas have different strengths and different weaknesses in terms of their investment. Now, the other thing to consider is what strategies work best within those sort of regions. And again, I'm going to call it, so London, which is basically within the M25, commuter belt, Midlands, south of the north, and north. So these are going to be the bandings that I'm going to give, because it makes it really easy for us to sort of relate and understand how they work. So London itself, so there's only really a couple of strategies that I would recommend if you're investing in properties in London at the minute. So one is serviced accommodation. Be very careful with serviced accommodation. You are subject to VAT. Okay, so if you go beyond the VAT threshold, which is very easy to do in London, you could very quickly find yourself in hot water, because if you have to pay the VAT out, you can't just charge the people another 20%, because they're not going to do that. They're going to pay the average rate. That's what they're going to pay, which means you have to absorb that VAT cost, which can really affect your cash flow. So just be very, very careful of that. Providing you stay under that, you're fine. Either that or go gangbusters and get at least 7, 8, 9, 10 properties that VAT amount is mitigated by the sheer volume that you're doing and the sheer amount of money you're making. So the first one in London is serviced accommodation. Very, very expensive to get into. Just by the way, the finish you have to do is really good to make a good serviced accommodation. You're buying nice locks, you're buying nice furnishings, good finish, good carpeting, good. So you have to make it look really nice for the serviced accommodation to really, really have a good effect. The other one is HMOs. Okay, so this is, for those of you that don't know, HMO is house in multiple occupancy. Think of student accommodation. So you'll have several people that'll live within one house. Okay, so they'll rent by the room as opposed to renting the entire house. So this is what we call a HMO, house in multiple occupancy, depending on how you want to frame it. And that's essentially what a HMO is. So that works well because you can make significantly more money because you can charge by the room. There is cons to this. I mean, we have discussed it on previous webinars. So this is the overlap I was talking about. In a HMO, you've got much higher maintenance cost, much higher tenant turnover. So a tenant and a typical buy-to-let will stay between 3 and 7 years as average, and you'll typically have a void period of 1 to 2 weeks. In a HMO, they'll typically stay on average 12 months. Okay, some will stay forever. It always happens, but the vast majority, 6 to 18 months, is your typical tenancy time, which means then you have to pay another month's worth of tenant replacement and all those sort of bits and pieces, so tenant fine costs. Your maintenance cost is higher. You're typically covering the bills, your gas, your water, your electric, your council tax, your broadband, all those bits you're normally covering out of your cost. So with the energy hikes at the minute, obviously it has affected the bottom line significantly for a lot of landlords. And if you're a new landlord, getting into HMOs can be more expensive for lending. You've got to typically have at least 1 year's worth of experience to get the really good rates to make this work. But if you are in London and you want to make some money and you've got a bigger property, that is a really effective way of doing it. Same as you could do rent to rent. Okay, so rent to rent, I don't mean you rent a property off of someone else where you rent the property and then rent it out to other people. Unless you want to be a lettings agent, because that's all you are then, is a lettings agent, just for clarity. And you'll make it, other people are getting all the capital appreciation, all those sort of bits and pieces, and all you're getting is a fee for basically doing work. So you're trading one job for another. That's my legitimate belief, and it's something just to understand. So rent to rent, I mean, as in you rent your house out to somebody knowing that they're going to rent it as a HMO. Make sure your mortgage is the correct mortgage and your insurance covers you, and you have the correct policies. Because if you don't, you can find yourself in hot water. But if providing you have those, you can give the headache to someone else and they can run it. They can guarantee your rent and give you a certain amount. The other one is rent to serviced accommodation. Exactly the same principle. Make sure you have the right mortgage product, make sure you have the right insurance, and then you're covered. And then make sure whatever agreements you have with them are watertight. Okay, a lot of people do this very loosely. So we've got one of our sort of partners that operate within the London space, a company called City Rooms. They do rent to rent. They are probably the longest standing rent to renter in London. And they're massive. They got like hundreds and hundreds and hundreds of rooms. They're really good. Good guys. If you want to know their details, I can connect you. If you've got a London property and you want them to take that on, I'm more than happy to connect you and they can help out with that, make your life a little bit easier. But if you're in London, those are your two main strategies that you should really be focusing on. If you're moving a little bit more into the commuter belt regions, okay, so these are regions where sort of within 20 miles of the M25, as we discussed. So realistically, you're moving more into the homey areas, so people that live in homes as opposed to live in HMOs. If you're near train stations, so near really good transport links that would come into London, HMOs can work. Likewise, converted to blocks of apartments, which, by the way, also works well in London. There's big conversion costs and planning and building control and all the other bits and pieces, but it does work. Single lets in apartments can work, but typically you want to try and own the block because service charges and ground rents are ridiculous at the minute. Some of these block owners are taking the mick, 100%. And buy-to-lets can work, but again, remember what I said earlier. If you're nowhere near a train station and you've got a buy-to-let, it's fine, but you're probably not going to get the same lending. The interest rates are very high. You're not going to be making any money. If anything, you're probably going to be losing money unless you have a low percentage lending. So you only have a 50% mortgage instead of a 75, which might make you make more income. But the amount of money that you have tied up in equity there, you can make work significantly harder for you in the north of England. Okay, so those are sort of your strategies in the commuter belt. Now, if you move a little bit more into the Midlands region, so this is, sort of encompasses your Birminghams all the way out and around, west of Reading, so Oxford, those sort of regions. I hope I got my geography right on that one. Sort of east of Essex, central Kent, sort of these sort of regions. So in these regions, you can make HMOs work. Again, you want to be focusing primarily on, so for HMOs, for anyone who is interested in HMOs, there's a few things you need to make sure of. So the first one is demand. Demand is ultimately important because if you have no demand for HMOs and you create a HMO, you're not going to fill it, and therefore it's just going to cost you money and you're going to lose money. It's honestly, it is as simple as that. You can check demand through Spare Room. So Spare Room is a website. Look at how many houses for rent and look at how many people are wanting to rent in that area, in that postcode. And that will give you a ballpark. It's not 100% accurate because people will say, I'm happy to rent anywhere in East London. And then it'll encompass all of those postcodes. So, but they're not really, they only want little pockets within that. So it's a little bit deceptive, but it gives you a rough idea as to whether there's enough demand. You'll very quickly be able to tell if there's no demand and you're just like, well, there's no point. If there is demand, then there's a few places you typically want to get your HMO located near, and this is anywhere in the country if you run a HMO. So you want your HMOs to be in professional areas. That is always the primary. Housing association HMOs are brutal. Do not do it. So DSS tenant HMOs are brutal. Just don't do it to yourself. It's not worth the hassle. You need to make sure you're either close to a main train station. And I say a main train station, we all know the piddly little ones that most people don't even know exist. So main train station or a town center, a large town center, not a, there's 4 shops in my little village. It doesn't work. A town center or a large hospital. And again, not the local infirmary where, Bob and Mary run it and you know them and they're good mates and, there's 4 on the team. Like, again, a large hospital. And the reason is at hospitals, you always have staff and they will happily tend to stay within a HMO that is within sort of a 10-minute walk. The closer the better, obviously. Sort of 10 to 15-minute walk is kind of your max, and that's any HMO anywhere. Aim for that 10 to 15 minutes. So main hospital because you'll have staff that will stay there. Main town centre because you'll have working people that will stay there, or main train station you'll have commuters that will stay there. Okay, so these are some really handy sort of big tips if you want to run your HMO. So in your more Midlandsy areas, providing you're within those locations, a HMO can work, but obviously make sure you're aiming for professional people. Blue collar and white collar are bang on. If you go down to housing association, you are in a world of pain unless you're getting guaranteed rent through the council. Okay, so this is proper housing association rent. So Mears, Serco, these sort of places. If you want stock like that, we can offer, guaranteed rent, all those bits and pieces. We can do it, but we're not focusing primarily on it. But honestly, I've got hundreds of properties like that I can operate on. If it's something that you really want to focus on, just know it's going to cost you a little bit more money to get in. You can also operate buy-to-lets within in these areas, but it'll be kind of similar to the commuter belt, where your value is going to be quite high, your interest rate is quite high, which means your cash flow is going to be very low. Although you can probably get yourself up to 75% lending if you're buying in the right regions within these areas, so there's slightly more suppressed values rather than the wealthy areas. Buy-to-lets always work better in more suppressed regions. So the rule we always learned, and I've always taught, is if you're creating a buy-to-let, operate just outside of Beirut. Okay, now nothing against Beirut, but the premise is don't do it in the slums. Do it around the slums. So people who don't want to live in the slums will move into those areas. They'll pay a decent rent to not live in those areas, but at the same time, the values are low enough so that you can make a much higher rental income as opposed to the value of the property. So always invest just outside of the slums, not in the slums, and not in the nice areas, because they make no sense. Buy-to-lets are not bought in places that you want to live in. Buy-to-lets are bought in places that somebody else wants to live in, and they're happy to pay you a good rent for the value of that property. Just remember that. Don't try and finish the refurb to the same level that you want to live in. You are mental. You are wasting money. Okay. And I don't believe in wasting money. There's no point. It's a crying shame. You only have so much of it that you earn in your life. There's no point wasting it. Okay. So HMOs and buy-to-lets work well. You can make serviced accommodation work well, providing it's in the right regions. So serviced accommodation is much more about travel links, certain towns, or beautiful scenery areas. So Lake District, Peak District, these sort of areas. So you can make those work reasonably well. Towns, yes, if there's a lot of working people in those towns that travel into work. So Barry and Finesse is a prime example. So you've got a lot of people that work over at BAE Systems, and they'll travel in from all over the world to be there. So serviced accommodation can work there. Certain parts of Manchester, they come for sports, so on and so forth. So that's kind of your Midlands areas. As soon as you go into the south of the north, you're moving, so you can still operate HMOs, but HMOs are quite saturated within these areas. Also, if you do HMOs, look out for something called Article 4. So Article 4 is where the council have restricted the ability to create HMOs within certain regions. Okay, so you might be able to buy an existing HMO, but creating a new one within that Article 4 area, you can't do it. You just can't. Some people say, oh, you can do it, and blah. Don't bother. It's not worth it. It's just not worth the hassle trying to get that done. It's a complete faff. Honestly, it's a complete waste. But yeah, so the south of the north, HMOs can work. Again, same principles apply exactly as I just said in the previous one. Buy-to-lets are certainly a much better option. You can buy properties in those sort of regions for maybe 120, 130, 140,000. You can get some down to the 100,000. I'm talking houses as opposed to flats. Again, buying individual flats is okay, but just be mindful of service charges and ground rents. You can get burnt with those. But as a general house, you're typically buying upwards of 100,000. So you can get reasonable yields, reasonable rents, reasonable growth. So buy-to-lets work, as well as HMOs in very specific areas. Serviced accommodation, again, very specific areas, but that can work. Those are some strategies that are quite nice for you. And as we move into the further depths of the north, the reality is what you really want to be doing is, a lot of people try and make HMOs work in certain regions. I wouldn't bother. Buy-to-lets or serviced accommodation in very specific regions. But yeah, buy-to-lets is a general rule of thumb. You just knock it out the park. It's very, very easy, very simple, very low hanging fruit, very low risk, very low stress. And essentially you're making really good money. And on top of that, you get your capital appreciation. So those are your sort of primary strategies by region as you move up. And you'll notice that London is very adventurous, very risky. So your serviced accommodations, which, they went in the pan as soon as you had COVID, as soon as you have any financial decline, the very first industry in the world that gets hammered is the travel industry. Service accommodations in the travel industry. So these are the markets that would get absolutely slammed as soon as there's any sort of global financial duress or UK financial duress. So it's a significantly higher strategy. Same with HMOs is higher risk, not high risk, but higher than your standard investments. And that's because of utility costs, mortgage costs, and also tenant turnover, saturation, legislations. There's a few other things to be aware of there. So London, you have to be much more adventurous to make money, or, you're doing planning gains, you're doing developments, extensions, loft conversions, and you're hoping in the time it takes for you to get your planning and all the work done, the market hasn't turned by the time you get to that point. So it's a much more long drawn out and capital intensive strategies for London. Now you go all the way out into the north, like the furthest reaches of the UK, and there's certain regions which are just unbelievable. You can buy stuff, you're spending very little money, you're getting reasonable returns based on cash flow. You're getting reasonable capital appreciation growth, so 4 to 5%, price bracket dependent. And yeah, I mean, any major changes in interest rates, etc., don't really have much of an impact. So the next thing to understand is market cycles. So market cycles is understanding where the market is. And again, I went through this on a previous webinar, I think probably like 3 or 4 weeks ago. And if you haven't checked out some of our previous webinars, check them out. So like this, I load everything, just slam bang it full of content, and really, really important and useful information that you need to know for the marketplace. And the reason I do that is because I don't take coaching clients, I don't take mentorship clients anymore. And essentially I give away my knowledge, my insights, my experience, everything for free now, because I don't really need the whole coaching thing. Now what we're doing is we're just building out another phase of the business where it serves me better to just feed you guys that information for free. And if obviously any videos you watch, please do like, please do subscribe. I really do appreciate it. It helps the channel. It also helps us grow. So, if you're getting value from this, make sure you do like the video, you do subscribe it wherever you're watching it, whether it's on Facebook or whether you're watching it on YouTube or on Zoom. When the recording comes out, do please check us out on our socials and stuff as well. And do like and subscribe. That I appreciate it. But yeah, so the next one is the market cycle. So if you understand, like with anything, if you look at a previous graph of the UK property value, so just Google UK property market graph, okay? And what you'll see is the graph goes up and down and up and down and up, and it always crests higher and higher and higher. But the reality is a market always goes ups and down. And that is because it operates in cycles. Like everything that is alive in this world, everything operates in cycles. You have breathing, ups and downs, heat, expansion and shrinking, your heart rate up and down, whatever it is, everything has your ups and downs. It's how it operates. The UK property market operates exactly the same. Now, like the body, if you figure when your heart pumps, okay, and it goes doof, and it pumps the blood around your body, the blood isn't instantaneously in your toes at the same time as it is in your chest and your arms. Okay, it takes time for that blood to move. Now, it's quick. I'm not saying it's slow, but it takes time for that blood to move. Now, the UK operates like an extremely big body. Whatever the heartbeat of London is, will then slowly propagate around the rest of the country. Okay, and there's certain things. So if you figure in your body, you have arteries. So your blood pumps, the blood goes through the big arteries quicker than it does the normal small veins. So it'll go into the cities. So whatever happens in London will affect the closest cities first and the furthest cities next, and so on and so forth. And it'll all radiate out to the surrounding areas in exactly the same way as your body operates. Now, London was absolutely booming. If you think, if we go back, so 2011, so 2010, 11, 12, 13. So post-recession, London started going up and up and up. Okay, and then London had a bit of a fall, and you saw that effect hitting the rest of the country, and you're seeing that effect actually hitting some of the country now from back in 2012, 14, whatever it was, where you're seeing the slow degrading trend where the market boomed. So when I first started investing in Nottingham as a prime example, I didn't invest in Stoke or in Birmingham or any of these areas that were further south, for one very simple reason, because in these regions, the market was already too hot. So Birmingham was absolutely skyrocketing. People were in best and final offers, buying stuff for way above asking price, buying properties that needed refurbishment for full value, after works values, but the market was absolutely mental. Now that was a mark from what had happened, the boom in London back in 2010, 11, 12. So we were seeing that in Birmingham in 2012, 13, 14. So that market was too hot. It was way too hot for us to be able to touch. And I was trying to invest in Nottingham. Now, Nottingham, believe it or not, was also going through the throes of that, where when I first started investing in Nottingham, right back in 2012, 2013, I was able to get one or two things, starting to negotiate, starting to find some good opportunities. But that market became so hot within an 18-month period that it was impossible for me to be able to find good stuff. That's why I went further afield and I tried to invest before that the next market got too hot. And when I invested in Warrington, Wigan, these areas were still pretty sedate. The market hadn't really moved up, hadn't really changed since the recession times. The values were still pretty suppressed. And I was buying property that, that same property now, it would have, I would say at least 80% growth since 2050. sorry, 2015, 2016, when I was buying a lot over there with Taro. I think we bought between 2015 and 2018, and we sold off the portfolio in 2019. Long story. But the property prices between 2015 and now, I was buying stuff for 80, 90,000 that now is worth 150. Like legit, loads of it, loads and loads of it. There was the growth rate in that area because we bought ahead of the wave, okay, ahead of the cycle. Now this is what I'm saying about the trends up the country. And then what we started doing is, we stopped buying as much because we started focusing a lot more on the coaching and mentoring, and we started guiding all of our clients. And we were running mentoring from 2016 through to 2022. So 2015 to 22. And that was, 7 years. We ran the coaching, the mentoring. I think we trained literally, I think must be well over 10,000 people from the front of the room. I mean, we had over 2,000 in one venue, which was great. We literally privately mentored several hundred people. It was really fun. But what we did as part of that is we were busy showing people the data and telling them, okay, now you want to be investing, so stop investing around Manchester. The market's starting to get a bit too hot. Invest in Blackpool. Those areas haven't started to boom yet. Get invested in there. And a lot of our clients that invest in those areas, they've seen like 40, 50, 60% growth since they're investing in 2016, 17, 18 up in the Blackpool areas. And those same clients, we started telling them in 2018, 2019, okay, great. So Blackpool's starting to get a little bit hot. Start investing further north, go up to your Middlesbroughs, your Durhams, your Darlingtons, these sort of regions. And they started investing there, and brilliant, and that's that area now. So all around the real north, those areas are now starting. So if you figure where the wave is, so the wave obviously picks things up from the back. So if you figure where the wave is, it's actually moved to about halfway up the wave. So the market hasn't really started to see the price benefit, but you're starting to see an aggressive growth in the volume of properties that people are buying. So your demand is starting to go much better, which means your value growth is going to really start to push. And you're going to definitely see, in my opinion, and it's only my opinion, but I haven't been wrong with any of this stuff over the last 8, 9, 10 years. You're going to be seeing growth rates of 30, 40, 50% over the next 2 years within the north of England. And people that don't buy are going to kick themselves in the butt because it makes no sense. So in terms of the market cycle, you can see this whole trend, and I followed it all the way up from Midlands, all the way up the entire country. So to give you an understanding of what cycle we're in now, so right now, London is actually in what we call a bit of a cessation. So London obviously went up, and then it's dropped, and then it's now starting to find its way to be able to pick back up again. But you're struggling to be able to find the good opportunities because people haven't quite got to the point of realizing we're in a cessation. So the prices are still going down in London or hanging around as to the prices as to where they're at, because there's not a lot of confidence in the market, because of the interest rates, because of a whole bunch of different reasons. So London for me is not the time to be investing now until you see the rates drop, which I honestly believe you're going to start to see by the end of the year. And you'll see different ways in which they operate, the mortgage lenders, I'm convinced, where they'll be offering you 3%, but what they're going to do is they're going to bump up your mortgage setup fee, and they're going to just take that off of your equity. So it'll be added to the debt, which means when they refinance, they get their money at that point. But what that'll mean is that your interest rates will be lower, and as soon as that happens, literally like the day that happens, if you have the capital, London's not a bad place to be investing in, because you're going to see London absolutely freaking skyrocket again from that point on. And again, you're going to be waiting 2 years before that really has an effect in Birmingham, another 2, so on and so forth. So right now, if I were to tell you where to be investing, I'd say all the way at the north. So outer regions as to where you want to be investing, unless you're operating on a strategy that doesn't typically operate very well in there. If you're much more into the HMOs or the service accommodation, those sort of things, then I would say either the south of the north or the Midlands band are not terrible regions, but just understand, like, you're going to get burnt on rates. You are running a higher risk. You're definitely going to be putting yourself in a much more susceptible position. So as always, when you're in one of these positions, make sure that you've got the base of your pyramid. So those of you that have been to our events before will know, so we talk about the investment pyramid, and your investment pyramid is basically built on 4 foundational blocks. So your main foundation is your buy-to-let portfolio. So this is your bread and butter money, your cash flow, your income, but your security. So no matter what goes on anywhere else, you're financially covered. Your portfolio is not going to be at risk of being repossessed due to non-payment of rent, etc., or non-payment of mortgage, etc. Then you move up one level, so you'll do your HMOs, service accommodation, these sort of things. Then you move up another level, so then you're moving into, your sort of developments, commercials, those sort of bits. And then right at the top, is where you go into your blocks of apartments, your land development. So your big high risk stuff that takes forever to be able to work. But if it works, it's great. You make loads of money. If it doesn't, you won't be bankrupt because you created your security in the base of your pyramid. So my suggestion, if you're looking for something a little bit more cash flow aggressive, make sure you have the base of your pyramid set so you are financially stable. So if something happens and the HMO market stops working or the bottom comes out of the service accommodation industry, you're not going bankrupt like I've seen so many people do in the last 3 years through this entire sort of COVID, inflation, all those sort of bits and pieces. So in terms of investment areas, that's my best suggestion I can give you guys on where to be investing and when. And hopefully that gives you guys some really good insights. Now, to give you a little bit of a flavor, so this is just an investment opportunity, and this is just a prime example of some of the stuff we have. For those of you that have not checked out our website yet, trustbricks.co.uk, do so. You can go see a whole bunch of stock. I think we got, at the minute, I think we got 230, 240 properties listed on there. We've got another 100 or so coming on this week, hopefully by the end of the weekend. We have, give or take, access to, I think it works in somewhere around almost 3,000 properties now. That'll include individual apartments that form part of a block. We've got almost 600 million's worth of stock. We'll have over $1 billion by the end of the year, providing, touch wood, everything goes as planned. But there's certain properties that come up where you go, well, you can't not buy that. But you can't not buy that. And this is one of those that came up and I was like, actually, you know what? I need to share this as part of what we do so you guys can understand. So for any of you guys that are in a position where you go, I want to get investing. I don't know what I'm doing. I don't know how to do it. Or, I know that my money is losing value in the bank because inflation is eating it up. Or I've got equity in my house and that equity is dead. It's not doing anything. I'm losing money and I could be making a lot more money on that money, that kind of stuff. Or you've got, whatever it is, like this is the kind of opportunity you want to be getting into because it's really good return. So you've got a yield of over 8%, which means you're going to be making money every single month as a net cash flow, over £200 a month, which is decent. In today's market. But the other thing is you're also not spending through the nose. Your total investment on this is like 35, 40,000. You've got less expensive houses, but the beauty with this one is you're buying it for enough of a discount that you're basically creating money by buying it for a discount. So I think this one, so we're working on Zoopla valuations. Obviously, we're not Zoopla and we can't stand by those valuations. All we're doing is reporting them, do your own due diligence and research. We find Zoopla is pretty accurate about 80 to 90% of the time. The 10 to 15 to 20% of the time, it's not. So obviously do your own research, look at your own sold comparables. We will happily do that research with you. And if you wanted to have a call and go through whether a deal's a good deal, and we can check that out. But, you can see it on the comparables on our websites anyway, which will give you a good ballpark. But if these figures are as they show, you're basically making £38,000 for buying this property. 38 grand, just for buying this, you make 38 grand, just like that on the day you buy it, because that's the amount of money you've saved by buying it for that price. And if there's a 5 grand refurb, you've only made 33 grand, but it's still 33 grand you didn't have. Okay, so you're pretty much doubling your money by buying this property, which is absolutely bonkers. So a lot of people don't quite get that. This is why I always talk about, you get stuff with a good discount and it has a good yield. Like you need to be buying that like yesterday. And there's a lot of people that sit on the fence and go, oh, maybe I should. I don't know if I should. Is it a good deal? Blah, blah, blah. All you're doing is you're wasting money because you're missing two things. So one, you're losing the money that's in the bank because inflation is absolutely destroying you. But two, it's opportunity cost. So by not buying this property today, you are missing the opportunity cost. So the amount of money you would be making, you'd be making your extra 2.5 grand a year, plus you'll be making the extra 36 or 35 or whatever grand it is the day you buy it. So you're losing that money. Okay. And people go, oh, well, I haven't really lost it because I don't really invest. Well, that's like saying, if you'd have bought if you'd have bet on a winning horse, and I don't tend to like betting because it's different. This is guaranteed wealth. But if you'd put money on a horse that you knew was going to win, because this is going to win. If you were to put money on that horse and you knew you were going to make 10 grand, but you didn't put money on the horse because you just didn't want to, you still lost 10 grand. I don't care what anyone says. That's still lost money. If you don't buy this, you're still losing over 30 grand. It's still lost money. Okay, no matter how you skin that. So if you're in a position to buy, this is the kind of deal I would highly recommend you buy. If you want to understand how it all works, you want to talk to us a little bit more at length, do reach out to us. There's contact at trustbricks.co.uk and stuff that you'll see in a minute. Or you can actually connect to us straight from our website as well. Or you can just reserve it straight on the website, because if you go, well, this is a great deal, reserve it £500 and that's it. The deal is yours. We will then go and finalize everything with the seller. We'll go and do the viewing, we'll booking, refurbishment quotes. So we'll do all those bits and pieces. And we actually take care of everything for you. So for those of you guys going, yeah, but I don't know how to invest. I don't know what I'm doing. I don't know the steps. You know, I don't know how I do things. I'm worried I'm out of my depth. We actually take care of everything for you. Like we literally do everything for you. So we will arrange the bookings, the viewings, go and view the property, give you a video walkthrough, give you a full refurbishment quote. You're welcome to view with if you really want to. After that point, we'll connect you with a solicitor, the broker. We'll give you a full breakdown of everything you need to do step by step as to progress the deal. We will also assist you progressing the purchase all the way through to completion, you know, helping you set up insurance, all those bits and pieces. As soon as you complete on the property, our team will jump in there. We'll do the refurbishment to make sure that it's up to standard based on what we quoted. Okay, once the refurbishment is done, we'll do the tenant finding, we'll do the managing. If you want us to set up a limited company for you, run your bookkeeping, your accounting, your filing, your tax, we can do all of that stuff. We can literally do everything so you can be a landlord, get all the benefits of being a landlord without any of the pain of being a landlord. Okay, so when people say, oh, I don't know, I'm scared, blah, 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 it's bullshit. Okay, it's absolute bollocks. You are robbing yourself of an opportunity just by being scared. And you'll know how many opportunities you've missed out doing exactly that. So, you know, sometimes you need to stand on the pedestal and be heard and, you know, put your head above the parapet. Otherwise, you won't achieve what you're looking to achieve. So just something to consider. Deals like this come up, you should be buying them. Like legit, you should be buying them. So just to give you a bit of a flavor of how it looks, there's some financial information, there's some comparables, all sorts of stuff on the website. Do check it out. If you want to speak to us, okay, and you want to get some more information, you want to discuss a little bit more at length, do head over to our website, trustbricks.co.uk. You'll be able to see a whole bunch of stock. You can go and pick whatever you want, reserve whatever you want. If you've got any questions, reach out to the team. You've got a speak to the team button, or you can just email contact@trustbricks.co.uk. It goes to the team. I also receive it. If you're itching to jump on a call with me or someone on the team, just put it in contact at TrustBricks and just say, would love a call to discuss. You know, one of our team will get everything booked in. And you can have a chat with me or someone in our team to be able to see how we can help you move things forward. Do check us out on socials. So we've got Facebook, Twitter, LinkedIn, Instagram, YouTube. So definitely our YouTube, go in there, go subscribe there, please. And like the videos you get in there. But you'll see we've got a whole bunch of content and a whole bunch of ways in which you can reach out to us. We're literally doing 2 emails a day, you know, market information, deal of the day, events. So we run live events in London. We run that once a month. We run weekly webinars like this. So we've constantly got a feed of very useful information for you. So do check us out on all the socials and you'll get a whole bunch of useful information. And it's not spammy. We don't do all the spammy stuff. That's not how we operate. We send out stuff that we believe is of high value. We're not just sending out some generic crap that anyone could write up. We're sending out stuff that we know will add value to you if you legitimately want to build your portfolio, create some sort of financial security, create some sort of wealth, and create some sort of legacy. If you really want to do that stuff, then, you know, we can help you out and you'll get all that content through our socials and through our YouTube channel. Finally, we're into the end game of this webinar, this presentation. Questions. Have you guys got any questions? Is there anything you'd like to know? Is there anything you want me to cover again? Is there, you know, if you've had a good time and you thought this was really useful, please do just leave a comment, just say, you know, it was great, or thank you very much, or whatever else, you know, whatever it is, you know, you want to know anything about the company, anything about the deals, anything about how we operate, anything like that, please do drop it into the chat. I tend to find chat doesn't get very chatty at the end of the webinars, which is always interesting. But yeah, if you guys have any questions, I'm literally opening up what I used to charge people legitimately £1,000 an hour to do, which is coach and mentor. And I'm giving this to you guys for free. So I highly recommend you utilize the time as you can. Thank you very much for the kind comments there, guys. No, really appreciate it. No, and okay, yeah, thank you. Yeah, thank you, Sutta as well, by the way. Thank you. I appreciate the very kind comments. So what about people with lower budgets? So lower budgets, really good question there. So lower budgets, again, I would highly recommend investing in the north. You can actually buy houses where you're all in for maybe 25, maybe even up to 30 grand, all in every penny. And then if the refurbishments come in less, then you're in less money. So that's your really easy starting way for low budgets. If, however, you wanted to find a way in which we can help you create money, okay, and there is some people who say, well, actually, look, I don't have the capital to do this. I'm much more interested in finding a way in which I can create income, create money. What you can do is you can do something called white labeling. So to give you a bit of an example, that's a really good question. I will see if I can just share quickly to give you guys a bit of a flavor of how that works. So, so I'll just do a new screen share. Oh, wrong one. New share, other Safari. Okay, so this is our website for those of you that haven't been on our website before. We've obviously got a lot of properties on here at the minute, so go check them out. You've got some unbelievably good stuff, HMOs, etc. Ignore the return figure. It kind of doesn't really make sense. So we're changing that out. But if you want to know the different strategy, you can do buy to lets, it'll filter out by, or you can do HMOs, it'll filter out by, and you can figure out what it is you're trying to find off of that basis. So it makes it a little bit easier. If you're looking for apartments, apartment blocks, I'm gonna have to fix, there's a little typo in some of these. But yeah, if you're looking for other bits and pieces, that's a really good way to do it. Different price points. You say, well, I only want something worth, up to maybe 100 grand or whatever it is, as a buy to let. It'll then give you the information so you can see we've got a ton of stock that falls within this range. So the lower value stuff. Again, you can get some really good discounts on some of this stuff. So well worth taking a look at. Now, what white label is basically we have our site and then we also have partner sites, which is exactly the same. So if you operate this and you have this at exactly the same, it is what we call a mirror image. So white label is essentially exactly the same site. So you can operate as your own white label and you can get people to buy properties through you, and we will work with you on splitting commissions and splitting profits. That's kind of how white label works. So if you wanted to create an income that you don't already have because you haven't got enough revenue to be able to justify what you're doing, or you want to create some money that you can then go and reinvest and go and use to build your portfolio from scratch, reach out again to contact that. Just say, I'd like to talk about white label. I will then add you to the waiting list. We've literally just launched 21 white labels this week. We've got a waiting list of about 40 people now. So if you want to be added to that waiting list, we'll be releasing those 40 people over the next 2 months. By the time we hit 1st of June, we're aiming to have 100 white labels, basically. So if you want to be on that, then do just reach out. Do just say you want to be part of the white label groups, and yeah, we're more than happy to add you on there. Really good questions, by the way. Thank you very much. Is there any other questions you guys have? Anything else I can help with in the meantime, before I love you and leave you and sort of let you get on with a very nice evening? Actually, let me check out YouTube and see if we've got any sort of comments on there. Okay, looks like we have no comments on there. A bunch of viewers, which is good. So awesome, cool. Okay, what locations in Durham would you recommend for equity gain? Okay, so really good question there, Phil. So focus. So if you think of equity gain kind of like a I can't think of the term where you have a graph where you have your sort of mean line. So the higher the value within a certain location, the higher your capital growth will be, your equity gain will be. Unless you mean buying something where you can buy it for a good discount and be able to add value to it by refurbishing, in which case it's less about location, it's much more about just the deal. But if you're looking for something where you can buy something for a set price and you're going to get a capital appreciation rate of maybe 5% or 6% as opposed to the usual 4%, it's very much money dependent. So if you're buying in a slightly higher value area, you're going to get a slightly better capital appreciation rate. If you're buying in an area where you can buy houses for 40, 50 grand, your capital appreciation rate's like 4%. You're buying in areas in like Durham where you can get houses for like 90 grand, 100 grand, then you're probably going to be sat at around the 5%, 5.5%. Well, 5%. Once you go over 150, I think you move into 5.5 to 6%. Within those sort of locations. So really good question there, Phil. Hopefully that answers your question, by the way. Thank you. Good question. Yeah, no worries. My pleasure. Happy to help. Any other questions before I wrap up this evening and let you guys get on with your evening and sort of go and sort of relax and grab your coffees or whatever else you're doing for the evening and partying with the missus or whatever it is. So no, okay, cool. In which case, let me just say thank you each and every single one of you guys for tuning in this evening. I hope you had a ton of value. I hope this was very useful for you guys. If it was, please do give us a like. Please do check us out on our socials. You can register on our website. You'll be receiving emails from us anyway. You should do, now that you've been registered to our webinar, you should start to receive some communication from us. Generally really, really good stuff. So, but if you have any questions, buying with a business partner. Okay, perfect. So let me answer this question. So if you're buying with a business partner, one of the biggest things you want to do is you want to make sure you have your corporate setup, your corporate structure set up correctly. And by that, I mean, if you're buying with a business partner, you're either buying in personal names, which I would personally recommend against. Obviously, I'm not a financial advisor, so I can't tell you what to do and what not to do on a financial basis. But from my experience, I don't think it's a good idea to buy in personal name because of your tax offsets in time. Initially, it's not so bad, but in time, I think your tax offsets make no sense. So, so I typically recommend, in my personal opinion, not in my professional opinion, personal opinion, to do it through a limited company. And if you do so, you need to make sure you're aware that the number of business partners you have will dictate how many basically people get added to the mortgage. When you sign a mortgage deed, okay, you will sign as two different people. So you will sign as director or whatever of the company, okay, and you will also sign as you as a person. So that is actually two separate legal identities. Now, if you sign as you as a person, you're signing a personal guarantee, which is very standard. But as part of signing a personal guarantee, lenders will want you to get something called independent legal advice, because your solicitor is representing the company. They can't represent the company and represent you. So then you have to get another solicitor who will represent you and represent the fact that you have independent legal advice, independent of the company, on the paperwork you sign. And you'll typically pay a fee for that. The more directors you have, the more ILAs you have, the more ILAs you have, the more money you have, okay, the more money you're spending. So just bear that in mind, that there is going to be more costs for doing this every time you refinance, every time you mortgage, every time you buy. There's going to be more costs to be able to do this. So keep the number of partners minimal. And if you can do, if anyone's got bad credit or anything like that, obviously just be very mindful, because they will affect your mortgageability. What you can do is you can set up partnership agreements where essentially you'll have one who's the director and only shareholder, and you'll have a partnership agreement where essentially that agreement means that they have the 50% share, but it's done through a legal document as opposed to done through shareholding. Okay, so it's just a little bit different in terms of how you do it, but just know the one in the company is the one that takes more risk because they sign the personal guarantees, so on and so forth. Okay, so really good question there, by the way, Dean. Thank you very much. Hopefully that answers and helps. Obviously, if you guys have any more questions, you want to jump on a call, do reach out. Me or one of the team can assist with some of this stuff. Obviously, like I said, I don't want to be coaching and mentoring people, but I'm happy to give you some insights. If you are serious about moving forward and building a portfolio, I don't want to be used as a free repository for information where you're just going to want to sit down and talk to me and spend hours bleeding my information without any value return, because that's also not very cool. It's not fair. If you want to buy me a beer or buy me a coffee or buy me lunch to be able to pick my brains, that's cool. Just drop me a message. Happy to do that. I'm in London 3 days a week. It's really easy. So awesome. Thank you very much, guys. I legitimately really appreciate you guys tuning in. I hope you guys got a lot of value. Please do like and subscribe on our videos. I look forward to speaking to many of you guys soon. If you're catching this as a recording, feel free to make any comments or reach out to us on our website, and we're more than happily jump in and assist you with any questions you have. But thank you, each and every single one of you guys. Hope you have an amazing evening. I do appreciate you, and I will speak to you all soon. Cheers, guys. Bye-bye.